welcome to the Saving with Steve show, where we talk about the ins and outs of money, pretty much everything under the sun that relates to you having a happier, healthy relationship with money. My name is Steve Sexton. I want to thank you for joining us today. Again, we had a lot of feedback on last week's Isma Mangla's interview with Magnify Money. She talked about taking the steps so people can put themselves in a position where they're not living paycheck to paycheck. So it was a wonderful interview. You want to go check it out. If you go to the website, it's episode 71, and you're going to want to see that. This week, I'm going to be talking about how to transition into retirement. So I'm going to give you 10 or 10 little things that you can do that put yourself in a better place to transition into retirement. Now, last year, the state of California had over 660,000 people move out of the state to lower income tax states. The same thing happened to all high tax states like New York, New Jersey, Illinois, and more. The reality is states like California don't want to lose your tax dollars and do everything to keep you paying. That's right. They want to keep you paying. You're going to have to learn how to pass your state's domicile test. We have Brad Galbraith, creator of ChangeMyDomicile.com, to help you good folks like you to do it right. Now, next, we're going to be talking about how to transition to retirement. And Cameron, I've just finished the intro again. All right. So if you could dub in an outro for, I'm going to do that outro. Hey, I'm going to do the outro for the completion of segment 1. So here we go. 5, 4, 3, 2. You know what? One of the biggest things to do when you're about to retire is figure out how to transition. And those steps I just gave you, the things you can do, I'd recommend you go through it. Make sure you're talking with a financial advisor. You know what? We're going to have to take a little break, pay some bills here on Saving with Steve. Next up, we have Brad Galbraith. Hey, you're going to want to listen to this, especially if you're considering leaving the state of California like another 600 and some odd people, 1,000 people did last year. He's got some great advice to make sure you don't get stuck paying California taxes. So stick with us. We're going to be right back. Welcome to Saving with Steve, where we talk about the ins and outs of money, pretty much everything under the sun that relates to you having a healthier, happier relationship with money. My name is Steve Sexton. Welcome to the show. Just want to say thank you for sharing us with your friends, families, and associates. We had well over 337,000 viewers and listeners last month, so we're very excited with that. Now, last year, over 663,000 people moved out of the state of California. Many just because they wanted to go to a lower tax state so they can save a dump load of money, okay? And the same thing's happening with New York, New Jersey, Illinois, because they want to go to a tax-free or a low tax state. Now, the reality is these states don't like losing your tax business, and they want to make sure that you're not doing anything wrong so they can keep that business. So, you know what? You want to learn how to pass the state, what it's called, domicile test. That's why we have Brad Galbraith here, creator of the ChangeMyDomicile.com. He's going to help you good folks, just walk you through it. Now, we'll also be talking about the 7 big tax scams that are hitting here in tax season. And how would you like a technology tool that can forecast risk for investors? How would you like a tool that enables you to help identify when risk is too high so you can get yourself out of the market? Hey, you want to stick around? We have Sean Rolls at Watchpoint Analytics. He's going to walk us through it. Now, what I'd like to do is tell you a little bit about Brad Galbraith. Now, he's an attorney. He's a CPA. He's the author of State Specific Domicile Plans. Now, like I said before, people are looking at ways to reduce taxes. A lot of times that's just moving from one state to another. Some people, don't realize that their former state wants to keep their hands in their cookie jar from a tax perspective. And if they ignore the rules on how to change your domicile properly, hey, you could come up with a lot of stress like taxes, audits, it could be estate issues, it could be lots of things. So that's why we have Brad. Brad, welcome to the show.
Thanks so much, Steve. Looking forward to it.
And as I said before we got started, when our viewers and listeners heard about you being on here, this is a big topic because taxes are going up all over from a state perspective. And quite frankly, many states become unaffordable. So one of the best ways is to move out of the state. Now, help me understand how you got involved with the changing the domicile business, so to speak.
Yeah, sure. Many, many years ago, I guess maybe 20 years ago, I was practicing law in Indianapolis, and my wealthiest clients kept retiring and moving to Florida. And they kept saying to me, what can you do to help us? And I would say, well, I'm not licensed in Florida, so I really can't. And I'd have to refer them to someone else. And I realized pretty quickly that referring away my wealthiest clients who were tuned in to this domicile issue probably wasn't the best long-term strategy. So I took the Florida bar, opened an office in Florida, and ever since I've been helping people from higher tax states make that transition to Florida.
Okay, so I just got to say this. I've talked to many of my advisor friends, and I've had even some clients where they figure they can split a state, or one spouse is domiciled in one state and another in another, and for some reason, they're getting audited, they're getting hit with penalties and all that kind of stuff. So what I'd like you to do is just go, hey, what determines somebody's state registry, what state they're domiciled in? What determines that? Let's start there.
Sure. Well, for the most part, when we're using this term domicile, it's good to specify that a lot of people call that residency.
Mm-hmm.
Most states technically call it domicile. But you can, of course, have a residence in more than one state, but you should, for tax purposes, only have one domicile. And so there's a lot of your listeners, certainly, who pay state income tax to multiple states, but there is one state that there is their primary residence, and they may be paying state income tax, for example, in California because they own rental property in California. They may pay in Illinois because they have rental property in Illinois, but they happen to be domiciled in New York. And so their worldwide income is subject to tax in New York, minus some of those taxes that are paid in other places. So in general, when we use the term domicile, we're talking about really kind of tax residency. Now, what determines your domicile is state specific. That's one of the things that we have talked about a little bit. It's really not about the state you're moving to, it's the state you're coming from. Because every state has their own laws. That's just the way it works in our United States. It's not a federal law that determines which state you are domiciled in. It's your state law. So there are unfortunately plenty of cases that actually went all the way to the U.S. Supreme Court about what state a person was domiciled in, and the argument oftentimes was, "Hey, I've got more than one state saying that I'm domiciled in their state. Federal government or federal courts, you resolve this." And the answer has really been, for the most part, hey, states can have different laws. If you aren't smart enough to make sure that you are only domiciled in one state, there may be more than one state that tries to claim taxes. And so we have to look very specifically to the state that you are trying to change your domicile from, not just the state that you're trying to change your domicile to.
So in other words, whether you're New York, Illinois, California, which are some of the biggest, in New Jersey, some of the biggest tax states, you really need to make sure, if you're going to be living in Florida or in Texas or some other, like Tennessee, tax-free state, you really need to look at that. Like, for example, you probably you're from Indiana. So Indiana has, what kind of, like, I'm just going to ask about Indiana. What kind of rules or domicile tests does Indiana have compared to Florida?
Sure. So I can even be a little bit more specific than that. I would say, in general, about half of the states in our country have a two-pronged domicile test. The other states have a one-pronged domicile test. The two-pronged domicile test, the first part of the test is typically a number of days test. New York is probably the most famous of those states, where they say if you have a place of abode, if you have a place that you can live, whether rented or owned, and you are in New York 183 or more days, then you are a statutory resident, and there is no reason to move on to the second prong of the test. You are a resident of that state for their tax purposes, and any of the other things that you've ever heard of that you're supposed to do just simply won't matter. About half of our states have a law like that, where there is a number of days. Now, the number of days can vary a little bit from state to state, but most of them are in that 6 month in a day category.
Mhm.
Ohio is the one very unusual state where they don't have 6 months in a day, they have 7 months in a day. They actually are more liberal, surprisingly, and they have said in order to hold on to as many people as they can who will continue to come back to Ohio in the summertime or off season, they've said, we're going to be really liberal. You could be in Ohio up to 7 months. And if you intend to be domiciled somewhere else, we won't count that against you. So that they've gone the opposite direction of many states. And their thought is that way the former residents can continue to come back to Ohio, own second homes, do their banking and investing, and go to the doctor there and give to charities there. And they've decided that that's what's best. But in general, half of the states have this number of days test. The second part of the test in those states, and the second part and the only part of the test in most other states, is an intent test. And it is based upon your subjective intent. And unfortunately, there's no MRI machine that we can run a person through that lights up green if you intend to be domiciled in Florida and lights up red if you intend to be domiciled in New York. It doesn't work that way. And so every state has come up with different factors that they may look to objectively determine what your subjective intent might be. And that's what really varies very significantly from state to state. In some states, they say whether you have a safe deposit box in their state is extremely relevant. And in other states, that's just not even mentioned.
Mhm.
In some states, in only a few states, they say where you give to charitable organizations really shows where your heart is. And if you still give in your former state, that's very indicative of your intent. And yet other states say absolutely positively, we will not consider that because we don't want to harm the charities in our state. And so it is very state specific when it comes down to those indicators of intent.
Okay, so now so basically what you're saying is you can only have one domicile, okay, where your tax state is. You can't have two.
Well, certainly 2 states could argue about it.
Okay.
But you do not ever want to have more than one domicile, because that means 2 states are arguing over which one gets to tax you the most. So that would be a disaster. So we want to be careful so that you should not ever have more than one state of domicile.
Okay, so here's the next thing. Can you live in one state and be a domiciled resident of another? And you just talked about that 183 and stuff like that. Is there any states that have issues with that?
As long as we're talking about a second residence,
Okay.
then most states recognize, really all states recognize, that you may have a residence in their state and yet not be domiciled in their state. Now, as you might imagine, the people who are being audited, for the most part, those are people who have a home in both states. Those also happen to be all of my clients. My clients don't typically live where I live in Naples, Florida, year round. It gets rather warm in August, and they tend to head back north. So most of my clients have a residence in more than one state. And the fact that they have a residence in a northern state doesn't mean that they are going to continue to be domiciled there, but it does mean that we probably need to be even more careful in making that change of domicile, to dot the I's, cross the T's, do as many things as possible so that it will be very obvious that the intent is to be domiciled in Florida, despite the fact that there is still a home up north. Now, the fact is that one of the analogies that I really like to use that is kind of a visual that you can think of is an apothecary scale. So when looking to these intent tests, to the various factors, what we want to do is we want to pile up as many factors in favor of your low tax state as possible.
Yes.
You pile up whatever still weighs in favor of your northern state, and we want your low tax new state to greatly outweigh the other state. That doesn't mean that there's nothing in favor of the northern state. You may still have a residence there. You may have children there. You may still own a business there. But what we want to do is we want to make sure that if a fact finder, if a court or a taxing authority were to ever take a look and audit or even litigate, we want it to be very clear to them that this case just isn't worth pursuing because you've done so many things to heavily weight that apothecary scale in favor of your new state.
Perfect. Hey, we're going to hold on right there. I want to talk to you about many of those things that people can do when we come right back. So we're going to take a break. Got to pay some bills. We'll be back in a few minutes with Brad Galbraith. That's wonderful. Reset. Okay. Got to do the little commercial here. Okay. Hello, welcome back. We have Brad Galbraith here, attorney and author of the State Domicile Plan. Before we get back in with Brad, I want to truly thank you all for, whoops, what happened there? I want to truly thank you all. Oh, that went weird. I guess we're going to restart that.
Sounds good.
So Cameron, we're going to restart that one, okay? Cameron's the editor. Hello, I want to welcome you all back to the Saving with Steve show. I want to truly thank you for tuning in. I appreciate you letting your friends and family and associates know about the show. All the replays are available at savingwithsteve.us. Again, that's savingwithsteve.us. If you're enjoying the stories of helpful information and insight on Saving with Steve, then I encourage you to subscribe to our YouTube channel so you never miss a show, and check out a few of our affiliates at UK Health Radio, BBS Radio, Talk Radio New York City, E360 TV, and the Las Vegas TV network. All these networks are dedicated to empowering you to solve problems and then lift your spirits, as well as live a life of financial personal freedom. Also follow us at Facebook and join the Saving with Steve Insiders Club at savingwithsteve.us. You get all the replays, exclusive gifts from our guests, and more. So with that, we have Brad back. We're talking about the factors that people look at. Now, what specifically are some of those factors that the franchise tax board here in California or wherever it is here there in Florida, would they be looking at as factors for somebody's domicile?
Yeah, and there I can provide a bit of a list of those things that are somewhat universal.
Yeah, please.
Those things that really apply in most every state across the country. The word of caution is that doing just those things that are general may not be everything you need to do for your state. But some of those general things are the things that are really almost just obvious. If you're going to change domicile to a new state, you would get a driver's license in that new state.
Mm-hmm.
You'd register a car in that new state. You'd register to vote in that new state. If there's a homestead exemption, you would file for that homestead exemption in your new state. And one thing that may not be quite as obvious, but is true in many of our states, is if you're changing to a new state, there may be a form available either through a county or the state franchise board or the Department of Revenue, the taxing authority for the state, that allows you to complete an affidavit that says, as of this date, I intend to be domiciled in my new state. So in Florida, every county has one of those. It's called a declaration of domicile. It's completed in front of a notary, and you just swear that that's your intent.
Mm-hmm.
You then record that with the county, putting everyone on notice that that's your intent. Now, that's not going to do it. That's not going to be the determining factor, but it is very nice to have a very clear piece of paper that says, it is my intent as of February 25th, 2021, that I intend to be domiciled in my new state. So those are some of the universal things. But there's a few others that are certainly worthy of mention. And some of these are a little bit less obvious. I mentioned a safe deposit box earlier.
Mm-hmm.
Now, that's not relevant in every state, but I would say in at least half of the states, that appears either in case law or regulatory materials or state publications, that may be very indicative of a person's intent. If you have a safe deposit box still in your former state, it sounds like that really is your intended long-term, that's the place where you intend to eventually return.
Okay.
And that could be a problem if you're ever audited for domicile. A couple other things that are interesting that people don't always think about. One of those might be professional licensing.
Mm-hmm.
Many of us and many of your listeners are professionals of one sort or another, whether they're an attorney or a doctor or a nurse or a realtor or appraiser, you name it. if you think about it, you register as a professional with your state. That's a state database. If the state wants to determine whether they're going to audit you or not, a very simple thing they can do is look and say, all right, well, this person is still a licensed physician in the state of California, yet he says that he's now domiciled in Idaho. That doesn't really make much sense to us. We better inquire more. And so if you're changing your state of domicile, it doesn't necessarily mean you have to give up your professional licenses. If you're ready to, even better. But in most instances, people want to at least change from a resident licensed physician, as my example, to a non-resident licensed physician. If there is no differentiation between resident and non-resident, at a minimum, change your address. Do not continue to use your in-state address for those purposes. Use your new state address for those purposes.
Okay, so what about things like a doctor?
Yeah, and that varies by state. It's interesting though. Most states will say that when trying to determine your intent, again, there is no MRI machine. There's no easy way of determining that, and it's just a little bit too obvious to just ask, do you have a driver's license in your new state? And so what many states will do is they'll look to some of these less obvious things that they believe that if you were really intending to change your domicile, you would probably find a dentist and a primary care physician in your new state. Depending on the state, they may ask about other professionals, insurance professionals, financial professionals, accounting professionals, tax professionals, lawyer. Do you have these professionals in your new state? At a minimum, do you have them in that new state and maybe still in your old state with them coordinating? But there should probably be some connection with the new state. Now, that varies by state. Again, interestingly, I mentioned Ohio earlier. Ohio, when passing their laws, made the intentional decision to not count those things. Okay. In fact, what they wanted to do is have their state residents who are changing their domicile still go back for medical care in Ohio, still have the Ohio banks as their banks, still have the Ohio investment professionals and CPAs and lawyers. So it does vary by state, but in most states, your choice of physician, whether you have that in your new state or your old state, can be indicative of intent. Okay. Similarly, things like social and religious organizations.
Your church?
Your church. If you're a lifelong member of the Methodist Church in your northern state, it would only make sense that if you were changing your domicile to a new state, that you'd probably find a Methodist church, or some church at least, to attend in Florida. If you're a lifelong member of the University of Michigan Alumni Association, you'd probably join the University of Michigan Alumni Association of Florida. Mm-hmm. You would likely do those things. You'd also surround yourself with if you've been active in charitable activities, you'd probably find some of those charitable activities to do in your new state. Okay,
so now I'd like to, what are the things that people should consider before changing their domicile?
Yeah, certainly. I think it would only make sense to do a financial analysis and make sure that it makes sense. Mm-hmm. So one of the things that happens when you change your domicile is you give up your homestead exemption in your current state in order to get the homestead exemption in the new state. Almost every state says you can't have a homestead exemption in both states. Homestead exemptions are for the most part reserved for those people who are domiciled in that state. And some states, the homestead exemption is very significant. Just as an example, in Michigan, the homestead exemption is very significant. I've done the analysis for clients before where we ended up deciding that their savings on income taxes were outweighed by the additional costs of giving up the homestead exemption. So it is important to not just hear that the new state is better, but to do the financial analysis, figure out whether it really makes sense to make that change. And if you're going to do so, when do those financial benefits kick in?
Yeah, no, that's great. Now, you know what, as I told you at the beginning, there's a number of people that we know that have gotten audited over this. Okay, so how do you defend against an audit? And how do you defend against an audit of a domiciled state?
Yeah, that really is a great question, because at the end of the day, that's what we're all concerned about. If you make the change and you get audited, oftentimes you've already lost, because if you're making a change and you're going into retirement, looking forward to spending some time with the kids and grandkids and on the golf course, and you end up in an audit, that's just not what anybody wants.
No.
So I would say it is very important when you make your change of domicile to know the state that you're coming from, to know it inside and out. And that is the idea behind changemydomicile.com, making sure that you have a state-specific list to go through. Keep records of everything that you change. If you're changing from a safe deposit box in your high tax state to a safe deposit box in the low tax state, keep that information. Have the records as to when you changed, when you closed the old box, when you opened the new one. Just gather information about the date that you registered to vote in your new state, the date that you gave up your homestead exemption in the former state. Keep all of those records. And importantly, because many states do have this number of days test, track your number of days, so that if you're asked, you know for sure that you're in good shape, so that even if you're audited on that number of days test, that you're not going to run afoul of the laws.
Okay, so now what I need you to do, because we have about a minute and a half left, I'd like you to talk about changeyourdomicile.com, how people can go and get involved with you, how people can get involved with that, so they can change their domicile right, so they don't get hit with the audit and the stress and all that.
That's great. Great. So yes, at changemydomicile.com, what we have done is we have gone through the 20 highest tax states, and done a specific state analysis for each of those states. What we have done is we've outlined so that it's easy to determine what is the financial benefit of changing from that state. What is the income tax rate in that state? How does the property tax exemption work in that state? Does that state have a gift tax, an estate tax, an inheritance tax? So that you can actually go through and quantify the difference between the two states. And then what we have done is we've gone through the state statutes, state regulations, and case law for each state. And we've pulled out the information that is specific to that state domicile decision, so that it's all in one place, so that our clients can read through that and see what they should be doing. And then we make it even easier. What we do is we have created a checklist for each state, very state specific, that based upon California, for example, what are the things that California says they will look at, so that you can go through that checklist one by one, keeping records as to the date that you made each of those changes. And so in doing that, your chances of audit, your chances of triggering an audit go way down. And certainly if you were to be audited, you at least know you've dotted the I's, crossed the T's, and that you're going to be successful in that audit if you've done the things on the checklist.
Thank you, Brad, for being part of the show. What's the best way that it's changemydomicile.com is the best way for people to get in contact with you, get the information, and so on, correct?
Absolutely. Changemydomicile.com. And once there's some free information, and then there's a link where you can download your specific state's package.
Brad, thanks for being on the show. This is a big topic. We'll probably have you back. So stay safe down there in Florida. We'll see you.
Great. Thanks, Steve.
Bye-bye. Hello, welcome back to the show. This is Steve Sexton. That was Brad Galbraith talking about changing your domicile. This is a big thing nowadays because many people are moving from a high tax state to a low tax state looking to save a significant amount of money. If you'd like to do that, you can obviously review the show, but you can also go to changemydomicile.com to find out exactly what you need to do for your specific state. Now, next, one of the biggest things that's coming up is tax season. We're right in the middle of it. Oh my God. But you have to be aware of the scams that are occurring because there's 7 new ones. It's interesting. First of all, we have, the Social Security scams. All right. We're just going to go through all those. And you know what? There's certain scams where they've evolved around the Social Security number, but the new one is they're claiming that they'll suspend or cancel your Social Security number. Okay. This is basically a scare tactic. And to get you to answer, return a phone call to get your information. You need to know if this occurs. You just need to hang up and block the number. okay? IRS personal email, impersonation emails. Phishing scams are a common tactic among cyber thieves. And some of these, I just got this last night, so it might sound like I'm reading a little bit, but here's what the deal is, okay? They're not limited to tax-related scams. However, one of the common tax scams is to send a variety of legitimate-looking emails appearing from the IRS, okay? Then they contain subject lines like automatic income tax reminder or electronic tax return reminder. They'll provide links for a temporary password, okay, to access your file and get your refund. Now, these files, you have to understand, are malicious and contain malware, which means they can track all your steps in the computer, all the little key codes, and take your financial information. I don't want to do this. Remember, the IRS will never contact you via email. Don't open up the email from anyone claiming to be from the IRS, and certainly don't click a link or download files from these, okay? Next, calls from what's called the Taxpayers Advocacy Service. Hey, guess what? This is actually a legitimate service or an organization inside the IRS. But you know what? The Taxpayer Advocacy Service will never call you. You have to call them. So if you get a call, the scammers, you know, they demand payment or may claim you have a refund waiting, but either way, they're trying to get personal information or get you to send them money, which means they're stealing from you. So make sure you understand that. Next thing is ghost tax return players. You know what? This is a big thing. It's happening all over the country. And basically what's happening is you have so-called preparers. They typically don't have any sort of credentials for preparing taxes, okay? They may require payment in cash or not provide a receipt. They also invent income or claim fake tax deductions to boost your refund, demanding you pay in the form of a percentage of your tax refund. You know what? You need to note that legitimate tax accountants, CPAs, enrolled agents, people with a preparer's tax ID number, and I know this because I used to have a preparer's tax ID number, will have the credentials that qualify for them to handle taxes. They'll also never promise you a large refund. They will offer you several payment options, won't try to pad your return, and will always sign the return, including their preparer's tax ID number. So the big thing here is this. If they don't sign your refund, ask for cash, and they don't have a taxpayer's ID number, they're fake. They're a ghost tax preparer. We have seen people come into our firm and say, hey, what's going on with this? Because they got an audit from the IRS and it was on the year they got the highest tax return. Well, they had one of those ghost preparers do it. Watch out for yourself. The next one is unemployment benefits. Oh, geez. Because of the pandemic, millions of Americans lost their jobs permanently or even temporarily in 2020 and received unemployment benefits issued by their state agencies, okay? However, in some cases, criminals sought to exploit the situation, filing fraudulent unemployment benefits using stolen identities, okay? I want to be clear, this is a $39 billion problem in the state of California. Because of unemployment benefits are taxable income, you're going to get a form 1099-G, okay? And in box one, it's going to show unemployment compensation. But here's the issue. If you didn't receive the money, okay, that means somebody stole your identity to file for unemployment. And if they did that, you're going to need to talk to the state agency that deals with unemployment to get the form corrected, okay? Now, if you can't get your form corrected before you file your taxes, make sure you file your taxes on only what you actually received, all right? And make sure you put a notation that your 1099-G or that unemployment compensation is false or erroneous, okay? Next, one of the big things we want to take a look at is the natural disaster scams. Now, this is happening here in Texas, in any state that actually got hit by that cold front there with all the snow. Texas had no electricity, they had no water. We're even seeing parts of this with the pandemic. It's just crazy. But the IRS wants to remind people that criminals and scammers are trying to take advantage of the generosity of taxpayers who want to help victims of major disasters. The fraudulent schemes normally start with unsolicited contact by telephone, social media, email, or in person using a variety of tactics, which means they're going to come and see you. Now, here's the thing. Some are going to impersonate charities to get you send money or get your financial information. They're going to set up bogus websites using similar names to legitimate charities so you send in the money. They're even going to claim to be working on or before for the IRS to help victims file casualty losses or get big refunds. Others are going to operate bogus charities and solicit money or financial information by telephone or email. Okay, so it's important that you check the charities out. Check out your Better Business Bureau. Check out the FBI and also check out the IRS website. Next, phone scams. Oh, there's a sophisticated phone scam that's targeting taxpayers, including recent immigrants. They use video relay services to try and scam deaf and hard of hearing individuals, as well as people with limited English proficiency, and they're making the rounds through the country. Callers claim to be IRS employees using fake names, fake ID badge numbers. They know a lot about their target, and when they call, the caller ID says IRS. Victims are told that they owe money to the IRS and must be paid promptly through a gift card or wire transfer. Victims may be threatened with arrest, deportation, suspension of business or driver's license. In many cases, the caller becomes hostile and actually insulting. Victims may be told that they have a refund due to try and tick them to share their information. Hey, the scammers are obviously asking, leaving urgent messages for you to return. Okay. Now, here's the thing. I don't want anybody to get scammed. And I see this happen a couple times a year, every single year with people. So here's some tips that you need to know in order to make sure you don't get scammed. Now, here we go. The IRS does not initiate contact via email, text message, or social media to request your personal and financial information. They also don't make phone calls. They send letters. Next, they will not demand immediate payment using a specific payment method, meaning prepaid debit cards, gift cards, or wire transfers. They always mail a bill first. Now, it is your right as a taxpayer, and you'll be given the opportunity to question or appeal the amount you owe. They will not demand you pay taxes without offering you this opportunity because this is your right, okay? In fact, they probably won't get too aggressive for you for a few years, okay? They will never threaten you with action from law enforcement. They cannot revoke your driver's license, your immigration status, or your business license. So that's important to know. And the IRS recently started doing in-person visits for those who've owed taxes for a long time. If you do get someone at your door claiming to be from the IRS, they should always provide you with two forms of ID, a pocket commission and an SPD-12. That's an H, Harry, Sam, Paul, David, 12. They need to have that card. You have the right to see these and to confirm their credentials. If you ask to confirm those credentials, they should be willing to give you an IRS phone number to do so. Now, if you think you're involved with a phishing scam, forward at thephishing@irs.com. If it's a tax scam and you're not sure, all you need to do is go to the IRS website, look for tax scams. Go to the FBI websites. There's many different websites that you can go to make sure you get the information that you're not getting scammed. You know what? We're closing up the show just quick here. We had Brad Galbraith talk about domicile. Hey, changemydomicile.com. Changemydomicile.com. You can get the information there if you're looking to move out of a high tax state into a lower or no tax state. Get the tax scams. You can see that on the website as well as week. We're looking forward to a wonderful show. We'll look forward to seeing you then. Be safe, be healthy. Back then. Bye-bye.